Coming up on Market to Market, the Agriculture Department releases its latest estimates on supply and demand. Washington state voters consider mandatory labeling on foods containing GMOs. And in Colorado, the electorate ponders splitting its state to address an urban-rural divide. Those stories and market analysis with Don Roose next.
This is the Friday, November 8 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Despite a 16-day government shutdown, an 11th-hour deal averting default on America's debt, and uncertainty over the botched rollout of Obamacare, U.S. businesses stepped up their hiring in October. The Labor Department reported Friday that employers added 204,000 positions to their payrolls last month. The unemployment rate, however, ticked up a tenth of a point to 7.3%. But that was likely because furloughed federal workers were temporarily counted among the ranks of the jobless. The report did contain a few causes for concern. The percentage of Americans working or looking for work, known as the labor force participation rate, fell in October to a 35-year low. Again, though, that figure is believed to have been distorted by the shutdown. And the government reports the U.S. economy, as measured by gross domestic product, grew at an annual rate of 2.8% in the third quarter of 2013. That's up 0.3 of a point from the previous three-month period. But consumer spending, which accounts for more than 70% of U.S. economic activity, grew by a tepid 1.5% in the third quarter. Though positive, that's down 0.3 of a point from the previous 3 months. Reduced consumer spending is a troubling development for the economy, especially as retailers' all-important holiday shopping season gets underway later this month. But critics of mandatory labeling on products containing GMOs received an early Christmas gift this week from voters in the Pacific Northwest. Some of the nation's top food companies, along with biotech and grocery organizations, claimed victory against a Washington state ballot initiative this week. I-522 would have required mandatory labeling of food and beverages containing genetically modified organisms, or GMOs, in the Evergreen state. Voters appear to have rejected the proposal, a decision which may have ramifications around the country. However, due to Washington's vote-by-mail law, an official certification isn't expected until December. GMOs are controversial because of perceptions that plants engineered with transgenic traits could open a Pandora's box of health problems for the general public. Advocates of the proposal say consumers have the right to know the contents of their food.
We don't want to treat consumers like idiots. We want to give them information. We want to entrust them to make decisions that are good for themselves and their families. We want mothers to know if their infant formula contains GMOs when there's a doctor's organization in the United States that says don't feed your infant genetically modified infant formula. So this is a fundamental right for people to know what they're putting into their bodies. 64 other countries either ban GMOs outright or require labeling. And when they did require labeling, prices did not go up by 1 penny.
Critics cite logistic difficulties, complex supply chains, and added costs, which likely would be passed on to consumers, among reasons for disapproval.
Don't be fooled by misleading attacks. Trust yourself. You have the right to know. Yes.
Early polls suggested voters supported the measure, but an influx of out-of-state money for TV and radio campaigns seemed to have turned the tide.
As an organic farmer and a scientist, I oppose Initiative 522. There are already reliable nationwide labeling systems for organic and non-GMO foods.
Proponents, including Dr. Bronner's Magic Soaps, the Center for Food Safety in Washington, D.C., natural food companies, and private donors spent $7 million in their quest to identify all biotech ingredients in food. But they were outspent 3-1 by those against the labeling initiative. $22 million in opposing funds came from Monsanto, DuPont Pioneer, and the Grocery Manufacturers Association, which collected hefty donations from many food corporations, including Nestle, General Mills, Coca-Cola, and PepsiCo. Twice victorious food and grocery suppliers are fresh off a 2012 victory that toppled a similar proposal in California. Prop 37 would have made America's top agricultural state the first in the nation to require GMO labeling. Over $34 million was contributed against labeling efforts in the Golden State last year, contrasted with just over $4 million in favor of the legislation. And while Connecticut did mandate GMO labeling this past summer, certain legal criteria must be met there before the statute can be enacted. Connecticut's rule declares that 4 other northeastern states must adopt similar laws, one of which must share a border with the Constitution state. And the states approving labeling mandates must meet certain population requirements based on the 2010 census. The only other northeastern state to successfully advance GMO labeling requirements thus far is Maine. So Connecticut could wait a long time before its proposal is fully enacted into law. In the wake of this week's defeat in Washington state, similar proposals to implement GMO labeling mandates in neighboring Oregon may be dead on arrival. And anti-labeling interests now are petitioning the federal government for a nationwide ban on further attempts to require labeling on foods containing scientifically altered DNA. Colorado's mercurial political landscape was illustrated dramatically Tuesday as voters overwhelmingly approved taxes on sales of marijuana, but rejected an income tax hike for education. Democrats pushing a $1 billion income tax increase to overhaul the state's funding system for schools were dealt a resounding defeat as 2 out of 3 voters rejected the proposal widely championed by the state's liberal establishment. On the flip side, a proposal to impose hefty taxes on marijuana was an easy sell to the electorate, about two-thirds of which approved a 25% tax on legalized sales of pot that begin next year. And in a development supporting the notion that Colorado is neither red nor blue, but purple, voters in nearly a dozen rural counties pondered splitting their state to address a growing urban-rural divide. Voters in 11 rural counties in Colorado were divided on a vote that would lead to the formation of a 51st state known as North Colorado.
All we're trying to say in the context of divide in politics is why is it that we should continue to bang our heads trying with very different value systems and very different views on the world and politics. Why don't we just, have a divorce?
At the core of the secession plan is whether voters in rural communities have an equal voice in the legislation that governs them. The dissatisfaction has been attributed to a number of recently passed laws in Colorado's democratically controlled state house. The legislation includes restrictions on the right to bear arms and establishes guidelines on how livestock producers treat their animals. Lawmakers also expanded regulation of oil and gas production and increased renewable energy standards, which many expect will have a big impact on coal mining and rural energy cooperatives.
I think today there is universal acceptance that there is a disconnect. It's a problem for the state of Colorado, and I think it requires all of us to have better dialogue and figure out ways how we address what created this disconnect.
With a population of close to 5.2 million people, the Centennial State is the 22nd largest in the Union and is the 5th fastest growing. Most of the gains are occurring in urban counties with already large populations, and only about 15% of Colorado residents live in rural areas.
Are you going to listen? Are you just going to belittle us some more and discount us as, well, we really don't matter? Because if you continue to do that, I assure you change will come.
The election ended with 6 of the 7 counties voting against the secession. But 5 counties where the proposal was approved can continue to pursue the long shot of forming a 51st state. The Colorado legislature and the U.S. Congress ultimately would have to approve the formation of a new state. That's considered highly unlikely. But the movement's leaders felt they achieved a victory by simply attracting attention to their plight. Voters in Telluride, Colorado, rejected a proposal Tuesday to tax sugary drinks. But a study last week suggested slapping a hefty tax on soda in Britain could cut the number of obese adults significantly. Researchers estimated a 20% tax on soft drinks would reduce sales by 15% and prompt consumers to choose other beverages like orange juice and milk. While the tax would result in a modest decline of 1.3% in obesity, scientists say that reduction will still be worthwhile since 25% of Britons are obese. Government regulations forcing consumers to eat more nutritiously were on display on this side of the pond as well this week when the Food and Drug Administration moved to eliminate a known public enemy from grocery store shelves. Heart-clogging trans fats were once a staple of the American diet, plentiful in baked goods, microwave popcorn, and fried food. This week, though, the Food and Drug Administration announced a ban on all trans fats. Artery-clogging trans fats are considered the worst for heart health. The FDA said this could prevent 20,000 heart attacks and 7,000 deaths a year.
They change your cholesterol levels and they promote inflammation in the body. And those two changes appear to add up to a quite large increase in heart disease risk. As much as 20% of heart attacks may in fact be due to these trans fats.
The additive is used in processed and fried foods and at restaurants to improve texture, shelf life, and flavor. Trans fats have largely disappeared from grocery stores already. Many companies started phasing them out in 2006, prompted by FDA-mandated labeling and local laws, like New York City's, that ban them. Dr. Alan Taylor likened the change to public smoking bans.
This is probably one of those things. It's going to be, in 10 years, we're going to look back and see further declines in heart disease rates and say, oh my goodness, that made a lot of sense.
The FDA has yet to set a timeline for phasing out remaining trans fats, which once lined supermarket shelves as a staple of the American diet.
Next, the Market-to-Market Report.
Weather forecasters are calling for generally favorable conditions over the next week, enabling farmers to wrap up the harvest. At the beginning of this week, 95% of America's corn was in the bin, as was 92% of its soybeans. Many growers have been pleasantly surprised by yields. And in its latest estimates on supply and demand this week, the Agriculture Department again called for corn production to soar to an all-time high. Despite persistent drought in many parts of the Corn Belt this past summer, government analysts increased estimates yet again on 2013 corn production. According to the Agriculture Department, U.S. producers will harvest a record 13.99 billion bushels this fall. That's up 146 million bushels from its last report in September. USDA pegs the national average corn yield at 160.4 bushels per acre, up nearly 30% from last year's drought-reduced crop. Government bean counters also increased their estimates on U.S. soybean production. USDA is now calling for total U.S. production of 3.26 billion bushels, up 3% from last month's estimate. If realized, that would be the third largest domestic soybean crop in history. The national average soybean yield is expected to increase to 43 bushels per acre, reflecting an increase of nearly 9% from last year. Turning to its monthly supply and demand estimates, USDA predicts record production will result in new crop ending stocks of 1.9 billion bushels. Analyzed as a percentage of demand, the domestic stocks-to-use ratio was unchanged at 14.6%. And USDA analysts reduced their season average price estimates by 30 cents from their last report to $4.50 per bushel. U.S. soybean ending stocks are pegged at 170 million bushels. An accompanying domestic soybean stocks-to-use ratio of 5.2% is tight by historical standards. Nevertheless, the Agriculture Department reduced its average price estimates by 35 cents from its last report to $12.15 per bushel. And the U.S. wheat stocks-to-use ratio is predicted to decline by 1/10 of a point to 23.2%. And after considering estimates of increased global wheat stockpiles, the figure prompted USDA to leave its season average price estimate unchanged at $7 per bushel. The Dow settled Friday at yet another record high. And as money poured into Wall Street this week, it appeared to flow out of the grain markets. For the week, December wheat lost 27 cents, while the nearby corn contract moved fractionally lower. Soybeans recovered all of last week's losses as the January contract settled with a weekly gain of 45 cents. Nearby meal prices followed suit with a rally of $27.40 per ton. In the softs, cotton declined this week as the December contract shed 30 cents per hundredweight. In the dairy market, December Class 3 milk lost 36 cents, while the January contract moved 12 cents lower. Over in livestock, December cattle gained 33 cents. Nearby feeders recovered nearly $1 of last week's losses, and the December lean hog contract posted a weekly loss of 23 cents. In the financials, the euro lost 14 basis points against the dollar. Crude oil gave up a penny per barrel. COMEX gold declined by $28.50 per ounce, and the Goldman Sachs Commodity Index lost nearly 3 points to settle at 608.55. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Roose. Don, welcome back.
Thank you, Mike.
The conversation this week centered on Friday's release of the Agriculture Department's combined October-November supply and demand and crop production reports. Break it down for us. How did the report come out, and how is that shaping the trade today and then into Monday?
Well, it was much anticipated because, like you say, we didn't have an October report. The trade went in looking for a negative report, supplies to grow. We've been getting yield reports that have been just terrific on corn and soybeans. So it was a well-documented bearish report. The big unknown was what was the demand going to be. The report came out, the acres were lowered on corn, soybeans, about what the trade thought. The yield was probably not as big as the trade thought, but the demand was really the great equalizer. In fact, the demand on soybeans pretty much just neutralized the increase in supply. In the corn, the demand was bigger than we thought there also. So the lower prices did their job. They built some demand, and we did have a good technical positive close on Friday.
Now let's break it down by commodity. As we look at the wheat market, we didn't see a whole lot of movement today, still large global supplies. How is that going to shape this market into the winter?
Yeah, and that's the problem with really the corn market too. But the wheat market, first of all, we do have just huge global supplies. So you're in a supply bear market. You know, we did get a relief rally, gave us some support. We pushed up to some real resistance areas, but now we're pushing back down, trying to find some demand. India's joined the mix and trying to sell some of their wheat XX supplies. You know, who would have thought? So that's really the tell of the tape for the wheat market.
How low can the wheat market slide?
Well, and that's the other side of it. I think when you look at that's the case with a lot of these grains. You know, the upside may be limited, but the downside, there's still good demand. And as long as the demand stays underneath, the market is supported. You know, the upfront wheat, soft red wheat under $6.50 has some buying interest. But when you get up close to $7, it runs into a terrific resistance. So you've really been caught. And we've been in this kind of a trading range for quite some time.
So for producers, as we're looking, we're on the low end of the trading range. Sit back, wait until we get some buying interest, maybe find a rally and sell into it?
Yeah, I think that's what you're left with. When you have big carryouts, big crops, you have to kind of pick your point of selling. And when you're down at this kind of a level now, oversold, watch some of those indicators because you'll get these technical rallies, you'll get short covering, and that'll be your opportunity. You know, 40 cents, 50 cents in wheat, probably enough to the upside unless weather changes.
Take advantage of it and keep an eye on the forecast.
Exactly.
Now, as we look over at corn, as you mentioned, the big shock that the market hadn't really priced in was the export increase that USDA put into this report. Was the market anticipating that we were done with exports? We were going to trade at 12 levels for a while?
Well, I think when you look at the corn market, you know, as we've gone down, exports have grown, you know, and that's been a terrific thing. So I think we were expecting that. Probably the surprise was the feed demand grew 200 million bushels. But and on Friday, Mike, we did have a key reversal on corn. So that's a technical indicator that we socked in an intermediate low. The real problem is when you're lugging around close to 1.9 billion carry out, we could see that grow over 2 billion if the yield goes up in the January report. The upside is also limited, and as part of these carries, if you rally the corn market 15, 16 cents, you're at 470 on July corn. So it's the carries in the market that attracts selling. So it's a market that I think went home on Friday with a positive note. You know, it's a matter of how much upside can we achieve in the marketplace before we run into selling.
And you did use a phrase that intermediate low does imply there's a lot more bearish pressure out there than bullish pressure as we go forward.
Well, and that's why we want to be really careful because we think this is a market that, you know, we're in a supply bear market, there's no doubt, you know, and it could be a multi-year supply bear market if the weather turns out to be favorable in the U.S. And around the world. So I think it's one of these that you can put in these lows, you can get these good technical rallies. You know, on December corn, there's going to be a lot of resistance up around 440. If we push through that, really tough at 450. And it really boils down to who comes in and participates in the selling end of it. Doesn't look like South America now, But does a U.S. producer, when does he pull the trigger and start to move stuff?
And where are we sitting with managed money, the non-commercials in the trade? They've been short corn for quite a while. Are they still short corn?
Well, and that's part of the reason we had a key reversal on Friday and a big turn in the market is because the funds are sitting with record short positions. And, this was probably the last of the big news, bearish supply news. From here it's just going to be tweaking stuff a little bit. So without weather problems, it's going to be this market that just kind of chugs along in these big trading ranges.
All right. Now, as we take a look over at soybeans, we have seen exceptional demand for beans all year long. And is that projected to continue?
Well, the soybean demand is just terrifically strong, led by the Chinese. The exports were up 80 million on this report, the crush up 30 million. What we really did is the new demand that we've created has really equalized the negativeness of the larger supply. So, but there again, it's what you really have from a producer standpoint, Mike, is you've got this window. You've got a 6-month window, and you're going to have South America really on top of us starting the middle of February. They have a big crop. When you're talking over a 5 billion bushel soybean crop, 5.2 or whatever you want to say, 5.3 billion. We raised a 3.2 billion crop this year. You can see there's a lot of competition ahead. So we've got an inverted market, and we've got bases that are strong. So the producer's goal is to sell the soybeans before he carries them into a declining market and before South America harvest.
So before he carries them into the declining market, China's beans could come to market here presently or shortly, if not already?
Yeah, I think, the producers in South America is going to be trying to sell and put some pressure on the market at some point in time, and that's just, something that you have to be careful of. All these markets, Mike, are really very similar to musical chairs. There's too much grain out here in the world, and it's who's going to take the chair before somebody else, and eventually we know, particularly in corn, that it's just there won't be any chairs left as you run into the summer next year.
Certainly, and in beans, we're pushing that $13 level in an inverted market. It's a signal to sell?
That's right. I mean, the soybeans, they were down in this sub 1250 on January beans. You get a lot of buying interest. You get up over 13 to 1320, a lot of resistance, and you run into selling, by people that are taking advantage of this, beats the market back down again, and you start over. So it's kind of this range type of thing, but that can change with weather in South America. We've definitely changed the weather focus to South America.
All right. Now, as we take a look over at livestock, we have seen the fat cattle trade stay strong. We've been staying in that the lower mid 130s now for a while, up again 33 cents this week. Cash trade seemed a little lower. Talk to us about where the fat cattle trade is headed at this price level.
Well, we had a supply-demand report on Friday, and basically it's not about the supply side, it's the demand, because the demand, our beef production next year is going to be down about 5.8%. Versus the previous year. So the numbers are going to decline. The second quarter, we're probably going to have supplies at a 20-year low. It's a matter of, with the economy, the way we are just kind of fragile. At what price will the consumer start to back away? We're going to have poultry is going to increase about 2.6% this year. Pork's going to increase about 2.6%. Total overall meat supplies are going to be slightly larger than last year. So you have to be pretty selective. The cattle market, you've 136 to 138 is pretty much the top end of the range, I think, in the futures and the cash. The downside, if you get, start to slip a little bit, you go under 130, maybe to the 128 area. So I think it's a market that's going to be all about the demand.
How should a producer be playing in a market with price levels this high?
Well, anytime you're at the top of a market where there's more downside than upside, I mean, I think we're talking about, okay, at 136, where are you going to go? 138, maybe 140. You definitely should take on some type of risk management protection at the top end of the range because, there's more downside potential if anything happens. Remember the mad cow years. So insurance is a good thing.
All right. Now, as we take a look at the other side of that and look at feeder cattle market, again, incredibly strong market. We seem to have stabilized, for lack of a better word, in that mid-160s. Can that continue as we watch corn with the key reversal today?
Yeah, and a lot of these markets, the feeder cattle and the cattle and even the hogs, so dependent on the grain market because we have a grain risk premium in the market. And if the market starts to go down, maybe we take some of this risk premium out and we change some of these levels. That's a little bit of a danger. But the cow-calf operator, he's in the driver's seat. I mean, we just don't have numbers. We have to rebuild the herd. We're starting to do that. Numbers are going to stay tight. It take a couple of years, 3 years. So I would say 160 on the downside on feeder cattle. You're probably going to see a lot of feedlot interest. You get up around 170, you're probably going to run into some resistance. But feedlots want to keep the capacity pretty full. So that is a good thing to help the feeder cattle.
That's true, especially as consumers are willing to pay in that 200 level for choice box beef. And the overall demand picture, as you said, looks pretty strong.
Yeah, the demand looks okay.
Now, as we talk about the other protein, take a look at the hog market. How is the market trading the PED? We saw a rise in values here the last couple weeks. It seems to have sold off a little bit. Where are we going from here?
Yeah, the hog market, says sold off $4.5, $5. And, of course, when we were up at the higher end of the range, it was all worried about the PED virus. And I tell you, if we don't have a big problem with the PED virus, hogs are too high. We're, I would say 90 even for the summer months is very attainable, and, we're closer to 100. And part of that comes about, Mike, if you look at the government numbers that they put out on Friday, still talking about pork production for next year, 2.6% over this last year. They're sticking with it. In the quarterly pig report, they said the same thing. So we're going to see if the numbers actually verify it. Now, this week, we actually started to see the slaughter go up. For months, we've had the slaughter under projections, 3-4% under what the government said on slaughter numbers. We finally went over a year ago on slaughter. Our weights are adding about 2.5% to the total mix. So, the weights are compensating. We have record weights on the hogs right now. But hogs, we put a key reversal in October 30th, and that really stalled the market out.
So we put a key reversal into the downside.
To the downside.
How far can we slip while the market sorts out PED?
Yeah, and I think what the only way you're going to be able to tell is watch the slaughter. But we do know that there could be backed up hogs. Guys are putting on extra weight because it's profitable to do it with grain prices sliding. So, the hog market on the downside, it feels like a December hogs, probably going to hold in that 85, 86 range.
All right. Thank you so much, Don. Appreciate you being here with us today.
Thank you.
That wraps up this edition of Market to Market. But Don and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll examine a pair of controversial reports on the pros and cons of the renewable fuel standard. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.